You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is developer and investment expert, Scott Lewis. Scott is a co-founder and chief executive officer of Spartan Investment Group and has led several successful real estate projects ranging from single-family flips to ground-up development of self-storage. To date, Spartan Investment Group operates more than 6,000 storage units, 200 RV pads, has completed more than $11 million in development projects, another $110 million underway, and has raised more than $30 million in private equity. Now, as Chief Executive Officer, Scott is responsible for developing business strategies and plans, ensuring their alignment with short-term and long-term objectives. In addition to Spartan, Scott is also in the U.S. Army Reserves and is an Operation Iraqi Freedom Veteran. Scott graduated from Michigan State University with degrees in chemistry and marketing, from Catholic University with an MS in management, and from Georgetown University with a certificate in project management. And so, guys, I'm excited to share the interview I had with my good pal Scott. But before we get on to it, I have a few quick housekeeping items to cover. And so the first announcement, guys, the one I'm most excited about, it's live. You've heard me talking about it for weeks and weeks and weeks now. But our latest mobile home park investment fund is now live. This is where you can partner up with me and my team and invest alongside us in multiple different mobile home parks across the country. This is our core competency. This is what we've been doing now for nearly a decade, and we'd love to be working with you. If you want to learn more about this investment opportunity, go to our website, sunrisecapitalinvestors.com, and click on the Get Started Today button. Just go ahead and fill out that short form, and you'll get placed on our immediate email list and also have access to our PPM document and offering memorandum. Again, go to sunrisecapitalinvestors.com to learn more. Moving on here, guys, we had recently launched a few months back a partnership program called Bring Kevin a Deal, and this is where I will pay you as much as $200,000 for any mobile home park or parking lot that you bring my way that I end up buying. Now, to learn more about this opportunity and to submit a deal for us to discuss, go to bringkevinadeal.com. Again, that's bringkevinadeal.com. And moving on here, guys, if you love what we're doing at the Real Estate Investing for Cashflow podcast, please subscribe so that you're made aware of when new episodes come out. And also, if you haven't done so already, please leave a rating and review on iTunes. It really helps us attract awesome guests such as Scott to the show. And then lastly here, guys, before we get on to it, I want to remind you of the free 30-minute phone call I offer each and every Friday where you can jump on the horn with me and discuss anything that you like about real estate investing. It doesn't matter whether you're brand new to the business, just getting started, or maybe even a seasoned pro. I'd love to chat with you and I'd love to meet you and discuss all the beautiful things about real estate investing. You can simply go to my website to get signed up, kevinbupp.com. All I ask that you do is just, when you're making that appointment, put a couple specific notes in there of exactly what you'd like to chat about during our call together. That way we can spend those 30 minutes as efficiently as possible. And now, guys, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Scott Lewis. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, CEO and co-founder of Spartan Investment Group, Scott Lewis. Scott, how's it going, buddy?
It's going fantastic, Kevin. Thanks for having me.
Yeah, man. Thanks for joining me here. And just to give you guys some additional insight, Scott's actually a really good friend of mine as well. I've known him for a number of years, and he's doing some big things out there. And so excited to have him here. In fact, Scott, you were on the show. I don't know how long it's been. I lose track of time with this little pea brain of mine, but I think it's probably in the last year or two we had you on, and we've also had one of your partners on the show in the past as well, Ryan Gibson. So excited to have you back, my friend. And for those folks that aren't familiar with you, your group, or what it is you do, maybe just take a few moments and tell us a little bit more about your maybe back up even before real estate. Give us your background and ultimately how you found your way into the real estate space.
Yeah. So my background is I've did some active duty Army time, was a government guy for a little while, but kind of started out as a regional sales manager for a biotech firm. So I've kind of had a little bit of a diverse background that I think has positioned me well to start Spartan. And at Spartan, we are developer syndicators. So, like Kevin does, we syndicate our own capital, but we do have development deals, ground up development, but we also focus on self-storage. So for us, we like the opportunity to control the entire value chain from the capital to finding our own deals and then also building them up. So a lot of the deals that we have are value add deals. Generally they need a lot of loving with them, and there a lot of times there's an expansion component to it. But inside of Spartan, we have all of those different business lines that we can do.
Okay, good deal. I appreciate that. And I want to talk a little bit about the time you spent in the military. And I guess the question I would have is, while you were in the military, did you have any type of dream or vision of getting into the real estate space, or did that come at a later date in your life?
No, great question. So, in addition to wanting to serve my country, I went into the military with kind of a specific task of generating leadership competencies and skills inside of me, because I didn't necessarily have real estate in mind. Although when I was younger, I put myself through college as a framer doing residential construction, and that was also my job in high school. So I definitely had an affinity for the built environment. And I bought a condo in 2005, which was a fantastic idea because I still, 15 years later, and I think I'm now just at break even. So I became an accidental landlord. I went into the Army a little bit later, but I did that by design because I wanted to go in and really get a lot of leadership training and experience. I thought about doing an MBA, but just didn't really think that the classroom or the collegiate environment would generate the leadership skills and competencies that I wanted, like the military would. So I specifically went in with that end state in mind. I never went in with it being a career. I'm still in the reserves, but that's kind of putting on my camouflage PJs one weekend a month and 2 weeks a year to kind of still serve my country. And even today, I still get some really outstanding leadership training that the Army provides. So definitely went in with an eye to come out for entrepreneurship, and then just coupled that with my affinity for real estate. And that was the genesis of Spartan.
Okay, good deal. I want to speak to those skill sets that you obtained during your time in the military, and really learn about how those skill sets, or how the military in general, prepared you to become a successful real estate investor and developer. Can you give me some specifics?
Yeah, absolutely. I think there's a couple of key areas where the military really provided an amazing foundation. And there's probably three that I'd like to talk about. One is leadership, two is planning, and three is risk mitigation. So I was an officer, I'm an infantry officer for the military. So before I would even stand in front of my first group of men, which is called a platoon, I went through 18 months of leadership training, basic training, which everybody does. Not really a ton of leadership training there, but then officer candidate school, and then a bunch of other schools for infantry that teach leadership and teach you how to actually, lead men in combat as I would go to do in Iraq later on, but also gave you a really good foundation of not only the technical aspect of it, but also the theoretical and conceptual as well, to understand the different types of leadership out there, and then really kind of put you in these experiential positions to where you're leading your other classmates or whatever in a very controlled environment, to where you can make mistakes and you can do stupid stuff, but yet not get anybody killed. Like later on, that very protective environment was taken away from you, that if you did make those mistakes, the consequences were very real. But the Army, did the best it could to make sure that you weren't going to do that by putting you in a lot of stressful environments. That's kind of, on a day-to-day basis in real estate development. I mean, we're constantly getting kicked in the teeth because of a changing operating environment out there, right? Like in the military, we have a saying, the enemy always gets a vote. It's generally not in your favor. And that's kind of the same way out there. Like anybody that's been in real estate development has gotten kicked in the teeth by a bureaucrat or a piece of dirt that a massive change order has come to them. And just kind of having that gone through those stressful experiences through the military and develop leadership competencies and emotional intelligence through that training has really kind of helped with real estate.
Yeah, no, that's great. I appreciate the additional context, man. And for those that are maybe thinking of enlisting, maybe at the early stages of their life, or maybe it's a later point in their life. I know that you went to the military later on, right? It wasn't like right out of high school or anything, or right out of college. But just generally speaking, for someone that's thinking about enlisting, or maybe someone that's already enlisted in active duty, what steps, if you could go back, because now you know what it looks like after you're done and you entered into the real estate world, right? And you learned a lot. If you can kind of back up and redo those steps over again, what advice would you give that individual that kind of wants to follow in similar footsteps to yours?
If you're going into the military with kind of an idea to be a career, or even if you're not, there are certain aspects of the military that if you take full advantage of, and that's one of the things I think I did very well, and it's probably because I had a plan going in. I knew that I wasn't going to be there for 20 years on active duty anyways. I knew that I was going in for a limited amount of time, and I kind of knew what I wanted to come out of it. So I jumped at the chance to build those skill sets, especially in planning and risk mitigation. A lot of times the military has kind of a negative view of staff. So there's two types of jobs. There's staff, and then there's operational guys that are out there like kicking in doors and stuff like that. And I had kind of a bridge of both, but a lot of times staff is looked at not with the most positive viewpoint, but I really enjoyed my time on staff because that's where I learned in the Army, the military decision-making process, and then also all of the risk mitigation, was understanding those planning processes and really learning the administrative side of leadership and planning and operations in the military, which when I came out and then I was now a civilian, there's no kicking, well, for the most part, there's no kicking indoors when you're a civilian, right? If you're going to like FEMA or something or a police department, then yes, maybe. But if you're going into the real estate business, like, well, I don't know. Some of the guys that have some Class D apartments have probably
that's true.
Or like, let's be realistic.
Yeah, war zone stuff. Yep.
yeah. So for those of us that are staying away from the Class D stuff, my kicking indoor experience not so relevant. My time on staff incredibly relevant with leading a team of non-door kickers. That was really it. So for those to answer your question, for those that are coming into the military now, or those that are prepping to come out in whatever it is, really when you get an opportunity to go through some of that staff training or planning training, whatever service you're in, each service has their own planning process. Really becoming an expert in that will really, really help you when you get out.
No, that's great. And it sounds like you had an incredible level of self-awareness, right? Like, again, you went in with a plan. And so, obviously that self-awareness was derived from maybe aspects of your life that you wanted to improve on, right? Is there any advice, again, that you would give to someone that's looking to go and they want to have that plan? But what was some of the exercises you went through to identify those critical parts of your life that you wanted to improve upon and where you felt there were maybe voids or gaps that you wanted to close?
So there was a couple of things I think I did pretty well as a young guy when I was, so kind of my timeline was I graduated from undergrad and then I went and I was a regional sales manager for a biotech firm, just a civilian. Mm-hmm. One of the things I did there is I really took advantage of some personality assessments. And I've really had a growth mindset, even from the very beginning, to just try to continuously improve through both self-development, but also, professional development. And one of the things I did with I worked for a very small company and they didn't have an established 360 review process. So one of the things I had asked my boss is like, hey, can I do this informally and just ask some people to provide some input, both from, across, up, and then down as well, to kind of give me this really holistic feedback so that I can look at, gaps in my personality or, whatever, wherever I need to improve. And I used that plus the personality assessments and then also understanding that, hey, I want to lead people later on in my career. And I know that having an understanding of leadership, both in theory and in practice, mm-hmm. is vitally important to be able to lead and build a team. You can get that in other places other than the military. So I really had kind of an idea that I wanted to serve as well and just coupled those two things together. And then leverage those personality assessments and that 360 feedback where I was told where I needed help. And that's where the military came in. Yeah, the military will find your weaknesses and then put it on display for everyone to see.
Right. Good stuff. That's why you're so tough, buddy.
Yeah.
I'd love to pivot and switch gears here, and let's talk about the asset that you love the most. I'll leave it at that because you guys are involved in a few different things, but self-storage, like that's your core competency amongst many other things. But that is like where you guys spend a majority of your time and focus on the investment side of things. And so, and I'm sure we probably covered some of these bases last time we had you on the show, but just in case, again, those that are listening, hadn't listened to that episode, maybe walk us through what initially attracted you to the self-storage space.
Yeah, so there's really two things. So Spartan started in kind of residential, single family home, condo conversions, that kind of stuff. And quickly, a couple years in, we didn't like that. It just wasn't in our blood to do that. So we decided to make a pivot using the military decision-making process to identify a commercial asset that we wanted to go and pursue. We wanted to get into more cash flow investments, but yet still be able to leverage our development competency that we kind of cut our teeth on the residential side of the house. So one of the parts of that process is to come up with some evaluation criteria. And for us, we call them the 3 E's: easy to manage, easy to maintain, and easy to evict. So when we looked at the various asset classes, office, self-storage, mobile home parks, we looked at those, multifamily, which everybody looks at. Really what we came up with is self-storage was the best for us that adhered to those 3 E's. Mm-hmm. The other thing that we then looked at is what assets performed really well during the last recession in 08-09. Self-storage was one of the top performing asset classes, only second to medical office, mm-hmm. For the returns and also the amount of foreclosures that happened. So that's really what pivoted us into self-storage. And quite frankly, I hate people. So I wanted absolutely nothing to do with multifamily, nothing to do with mobile home parks. I didn't want anything to do with like any residential housing. So that's why when we looked at self-storage, I can tell you how many government jurisdictions give a shit if I sell somebody's stuff in their storage unit. 0.
What is I was going to ask you about selling the stuff in the storage unit. Obviously we got self-storage wars or whatever they're called, storage wars, all these other reality TV shows, and I'm sure you get asked all the time. But and I know you and I have had this conversation. But what is the coolest thing or the most valuable item that you guys have come across during an auction?
Home Depot bucket.
That's it.
That's honestly,
no classic cars or expensive musical instruments or anything like that.
I think we had one that just had a fur coat in it, and that unit sold for like $700. So I think our average sale is probably like $100 on a unit. And it was funny. We had one that was abandoned. So when somebody abandons a unit, we went in and just had to clean it out. It's just kind of our problem. We didn't auction it. They just abandoned it. And I went in there and we were just trying to make sure that any sensitive documents were secured and then properly disposed of if there was anything in there, just to protect somebody's identity, even though they just abandoned it on us. And there was nothing. This entire unit, it was a 10 by 20, that's 200 square feet times 10 feet tall, right? On the inside of the unit. That's a lot of cubic feet of absolutely no value. The one thing I took away from that was a Home Depot bucket. I was like, oh, I need one of these. And I was just like, okay, cool, I'll take it. That was it. It was really now do people store some good stuff in there? Absolutely they do, but generally those people pay. So that the whole thing on storage wars that people love is all this money that they're making. That's not reality. So in reality, the only thing that we can take is what is owed. The rest has to be mailed to the owner as a certified check. So
interesting. My guess is that the majority of those people in storage wars, they probably just have measly thrift stores or something along those lines, right? I mean, they're not killing it by any means. They're just probably barely scraping by. And now they happen to be TV stars, so now they have a little bit of additional income.
Yeah. None of the auctions have a guy with a full Manchu with a midget wearing nods or on his shoulders. That doesn't happen at all.
That's awesome.
It's rather low fanfare, but there are folks that have an entire business setup. One of the guys that buys units from us all the time, he has his own cube van. He's got an eBay shop, and he does okay. But he's got this thing down pat. I mean, it was pretty amazing to see how fast he cleared out these units because he's just got this little business going on, and he really enjoys it. So.
Yeah, fantastic. How about markets you guys are located or particular regions of the country that you're attracted to?
Yeah, so we're across the board. We're national, but we really stay in secondary and tertiary markets. the primary MSAs, there's some good opportunity there, but man, in self-storage, there's 5 REITs, actually 6 now, another one just launched, but the 5 main REITs, people have seen Public and Extra Space. Those are the main ones that are people out there. And man, those are big companies and they got really cheap capital. So going toe to toe with them is a great way to get your head punched in. So we really just want to stay away from those guys and just compete on the playing fields that we know that we can win. And that's really the secondary and tertiary markets. And we look at some of the very same fundamentals that other folks are talking about and just try to find the deals in those markets kind of away from those 50 MSAs that are the top ones in the U.S. And we look across the board. There's no, we're not in just the Southwest or the Southeast or the Northeast or anything like that. Mm-hmm. We do shy away from the coastal markets a little bit just because they're a little bit overheated. But but we have, I think, 31 different states and about 150 different areas that we look at within those.
So none of the REITs, none of the larger players are in those secondary, tertiary markets?
Occasionally they are. Yeah. You'll get a smattering, maybe like 1 or 2. Okay. But we're in a market. We have 1 property in a primary MSA, and there are 15 REITs within there, right? So sometimes there's multiple extra spaces there, but that one is not. That's not a playground that we like to play in unless we can get a really good deal, which is kind of what we did on this particular one.
Yeah. Well, and what are some of the what's the basic back of the napkin formula you guys use when you look at a particular market? I'm assuming there's probably a certain amount of square footage of storage needed for X number of rooftops, or a formula somewhere along those lines, right? Is there a rough back of the napkin that you guys use?
There is, and it's. So that's the one good thing about storage is there is a self-storage almanac that is produced every single year, and it provides an equilibrium number of square foot of storage per person that's there. And it varies on the different markets wherever it is. The national average right now is about 5 and some change square foot per person. However, it's one of those things that it's really kind of an art because we've gone into markets that, maybe it's 8 square feet per person in that particular market. And when we do the calculation, there's 12. Well, just quantitatively, that would indicate a potentially bad market, an oversupplied market. But then when you do the qualitative follow-up and you call all of these other facilities, they're at 97% occupancy across the board. Well, historically in storage, stabilized is 85%. Now that's come up in kind of the few recent years, but in self-storage's history, 85% was the number. Now the REITs have gotten really good at staying in the mid 90s, 93, 94%. So that 85% is a little bit of an antiquated number, but when you're seeing 97%, even within a saturation number that is over what should be in that market, that still could indicate demand.
Yeah, not to get off track or off, down or off the rails, I guess you could say is. But when you guys are making these phone calls to kind of, test what the current occupancy is, in that given marketplace, you use the example of, the almanac would say that there's, 8 square feet needed per person. However, this market has 12, but when you call, it's got 97%. Most of the places have 97% occupancy. Are they actually giving you that info over the phone? I mean, is there an approach you take to where you can actually get them to divulge what their occupancy levels are just by making a phone call?
So there's a couple different schools of thought. Some of us like to secret shop. Me, I just call and be like, hey, I'm buying the facility down the street. What's your occupancy? And you'd be amazed at how much the managers will tell you. And then we always go in person as well. And I'll walk in and just be like, hey, we're looking to buy, and I'll wear my Spartan Investment Group shirt. And I'll be like, hey, we're looking to buy the facility down the street. Because here's a double-edged sword. So if you don't treat your manager right at your facility, and there's a new player coming in town being like, hey, I'm buying this, like they're looking at you like their future employer because like, hey, this guy sucks. So, oh yeah, we're at like 97%, or like, oh no, we're at like 70%. We're not doing very well here. They are surprisingly forthcoming. Some you walk in there and they're like, hey, I'm sorry, I can't talk to you. You'll have to talk to the owner. That happens. Absolutely. Mm-hmm. But I just go in and just tell them who I am, what I'm going to do, and just be like, hey, I'm just trying to see if we're a good market here.
Yeah, very interesting. And then I'd love to talk about maybe a recent deal that you guys are done. Actually, walk through a case study in the self-storage space. Maybe speak to the location, the general size of the facility, price range or price point. You can share as much or as little as you like. What the value add opportunity was. I mean, what attracted you to that particular facility, and then what does the business plan look like to get you there to the finish line?
Yeah, I mean, we're actually closing on a deal a week from today, and it's
Okay.
a 4-property portfolio. There's 4 of them in Tyler and Longview, Texas. 2 different markets. They're about 45 minutes apart. 2 facilities in each market. Each facility is roughly 50,000 square feet. So we'll just use rough numbers there. They're all value add plays. So they're all like, they got good bones to them, but they just need a little bit of work here and there. And by a little bit of work, it's repaving drive aisles, resealing roofs. One of them has old school swing open storage doors versus the nice roll up ones. So we'll be putting doors on it. One of them has about a half acre of land where we'll expand and put some other storage on it. And that deal, we're picking it up for $8 million for the 4 facilities. And Tyler and Longview, those are secondary and tertiary markets outside Dallas by about 90 minutes, which is kind of what we like. The business plan there is really to renovate them and increase the rents up to market rate. They're pretty significantly below market rate, once we get all the improvements on there, and then the expansion play of it. So that's a very, very kind of similar Spartan deal. It's our first portfolio that we've bought. So that's like, we actually really enjoyed the whole experience of buying 4 facilities at the same time. There was a lot of value for, not a linear amount of effort for 4 facilities. There was a lot of economies of scale. Yep. Buying 4 facilities kind of right next to each other. So
yeah, no, absolutely. And I want to talk about the debt, but before we go into that topic, what was the existing owner, or what is the existing owner's profile? Because you haven't closed on it yet, but is it a mom and pop? Were they original developers of these 4 facilities? Is it different owners? You mind sharing?
No, that's fine. It's a single owner. The gentleman's dad did a lot of the development here, and he inherited them. They've owned it for decades. And he is now living in California. So having these properties in Texas is a struggle, that when he has to go there to operate them, it's just not something that he wanted to do. So it was actually an interesting story. He was just selling 3 of them. And then we heard that, like, oh, well, he owns this other one too. And we're like, well, we'll buy that as well. And we actually convinced them to sell the 4th facility to us, and just like, hey, just take everything off the table. So, I wouldn't call him a mom and pop, but he's definitely not an institutional guy. He was a single person who was just managing all of them, and he was doing a good job. He was doing it from California, and just not necessarily putting the level of effort and kind of institutional systems that we will put in there. So there is some value to drive.
Gotcha. And then what kind of debt's available for that type of acquisition?
We're doing life insurance money on that one.
Okay.
So I think the loan is about $7 million. So with the total deal size is around 11, with fees, expansion capital, renovation capital, all of that, there's about $3 million on top of the $8 million of all the capital that is needed there. So we are kind of above that $5 to $6 million range, where life insurance money starts to look at that. And we've got partial recourse on that. I think our interest rate's like 3.75. So it's a good loan product. And it's one of those that kind of balances LTV with overall cost of the loan. Now there is some prepayment stuff associated with life insurance money.
Yep. And I'm guessing that the LTV, the number one, they're factoring in that $3, give or take $1 million for that expansion, correct? And the improvements that you're going to make. And is the loan to cost, what is it, in the 70% range, 75%? How far did they go?
Yeah, just right in that range, but it does not include the expansion capital. We're going to have to do a subsequent raise to get the money to expand. It does include the capital improvement side of the house, but they didn't want to touch the expansion. But what they do have is a supplemental loan that they've wrapped in there that they said that they will do for no cost once we get it built and stabilized at a break-even number. They'll take out probably what will end up being more expensive capital for the construction side of the house.
Got it. Life companies they're one lender I've never dealt with. I'm kind of familiar with them, but it's very much in line to what those that are in the multifamily space or even mobile home park space might get as far as the terms are concerned from Fannie Mae or Freddie Mac. I'm assuming it's 25 or 30 year amortization.
Yes.
Yeah. Okay.
I don't remember if it's 25 or 30 year, but I think it's 25-year AM.
Yep.
And it's not quite as good as the Fannie Freddie stuff because that's just not like that. Like those government backed loans are bananas. But it's
well, that doesn't exist in your space either, though, correct?
No, it's not. No. Yeah. So this is one of the better loans. All of the terms are fantastic. The only drawback is not having that expansion capital because that's kind of outside the risk profile of what a life insurance company would do. And the good news is there's only a couple of conduits to get to this life money. And so we're establishing the relationship with that conduit. So there'll be some future opportunities should the relationship play out that it's advantageous on both sides. There'll be a lot of good opportunities coming in the future.
Yeah, that's great. And I mean, there's really only, and correct me if I'm wrong, as far as non-recourse debt, really the only options in the self-storage space would be probably CMBS. I mean, that's really it,
there's
correct?
Debt funds out there, but you got to kind of like, so we have non-recourse debt on a lease-up facility, that one in Fort Worth, but it's got to fit in this box just perfectly. When there's an expansion component or a heavy value add component, most folks aren't going to do that non-recourse. This one it's 50% recourse, so it's not non-recourse, but it's not full recourse either.
Gotcha. Let's switch gears again if we could, and staying on the topic of self-storage, but speaking to the current state of affairs that we're experiencing in the country, and just to give folks a little context here, we're recording this on August 25th, and so it might be 4 or 5 weeks delayed here. But I'm assuming even by that point in time, the topic or conversation around COVID is still going to be real, and it's not going to be a time of the past, at least not within the next 4 or 5 or 6 weeks. And so, with that being said, do you expect the self-storage industry to experience any major or even minor pain in the coming months or years, as more of a snowball effect due to COVID?
So it's it's been an interesting kind of analysis that we've been doing. In our portfolio so far, our delinquencies have gone down, not up, and our occupancies have stayed pretty stable. And I think that's because there's a couple reasons. During the more severe restrictions, it was really hard for people to move out. So what you looked at was just people weren't able to get to their unit to move out if they wanted to. Now that's generated some ghost units that people that should have been moved out or evicted have not been evicted. There was a little bit of a moratorium on that kind of stuff, but most of those are gone. As I mentioned, the governments will. There's some more states that are more favorable for the tenants, but generally not in self-storage. Only a couple of states that really kind of stopped it. But for us so far, it's been pretty good. And, it's kind of historically, self-storage is kind of a lifestyle asset, whether it's doing well or bad. Self-storage does pretty well because in really good times, people buy a bunch of stuff that they don't have any room for, and they put it in storage, like four-wheelers, boats, all this other stuff. On the flip side, when things are going bad, it's about to start, depending on what the government does, is these mass evictions are starting to start. Well, people need to put their stuff somewhere. And for self-storage, when you look at it on a multifamily, let's just take Dallas, for instance. How much is a 2-bedroom apartment in Dallas? I don't know, $2,000 a month? I really don't know. But it's certainly not $164 a month, which is what, a 10 by 10 is, or $200 a month for a 10 by 20 unit is. So, the folks might lose their apartment, but most people can come up with a couple $100 a month to store their belongings. So when you look at the amount of money that they need to actually take advantage of the piece of real estate that we have, it's not that much. So we don't expect to see huge drops. In fact, if these evictions start to come in mass, we actually expect to see demand increase because people don't want to sell their belongings or throw their belongings away during a bad time. They want to store them such that, when times get better, which they inevitably do, they can grab those prized belongings out of storage and put them back into a new apartment.
Yeah. No, great point there. And the American part of the American dream is having a bunch of excess junk that we really don't need, but for some reason we just really don't want to part with.
No, it's interesting. We have a unit in our Conifer, Colorado, and we joke that it's an elderly woman who's in your area down in Florida, and she hasn't been to the facility in 20 years.
Oh my gosh.
and she still has a unit. And it was one of those things where when we took the facility over, her rent hadn't been raised since like the early 90s, right? So she was probably paying, I don't know, 10 or 15% of what the actual street rate was. So we were trying to be compassionate about it and just be like, hey, you know, we've got to get these rates up a little bit. And we understand you're significantly low. Like, we get it. You haven't been here. So let's try to come up with a plan. And she's like, no, just go ahead and raise it. I get it. So we're like, we're like, oh, it must be your husband. She killed him and has him in a box in there, and just like doesn't even care. Doesn't want to. I'm completely joking about that, but that's our joke with that facility. But you know, we don't know what's in her unit, but it's just, you know, I mean, she sounds like she's in her late 70s or early 80s. So I can't imagine she's coming back here anytime soon. And she just instantly like raised the rent and didn't care. So,
yeah, must be something of value in there, at least to her, right?
Yep.
So let's, real quick before we run out of time, I know that you guys, outside of self-storage, although again, that's your core competency, you guys have your hands in a few other pots as well. And so maybe speak to just some of the other investing activities that you guys are involved in there at Spartan.
The kind of the second area that we've looked at are RV parks, and we own 2 in West Texas in the Permian and Delaware basins, where the vast majority of the oil that's produced in Texas, that's where it's produced. Those were 2 kind of cash flow plays. You know, when we did our assessment out there, you know, we looked at the kind of the West Texas oil field as a pretty strong oil field. And even today, you know, with oil taking a beating, both in the commodities markets and then also with COVID, you know, both of those parks are still doing okay. One is just breaking even, but the other one is still producing, you know, pretty okay returns for the historically massive bust that we've had in oil that has never been seen before. They're still doing okay. So that's where we've made those 2 investments out there, because the 3 E's, the easy to evict, easy to maintain, and easy to operate, are still there with the RV parks. It's not quite as easy with RV parks as it is with storage, but it wasn't far off. And you know, we got pretty good deals on both of those, so we were willing to take the risk.
Got it. And it's RV parks. Is that another area that you guys are looking to potentially expand in?
It is. You know, it's one of those things. It's we like the RV parks. A little bit more management intensive than self-storage, but kind of like self-storage was when we started, it's a little bit fragmented. So we want to take the opportunity to kind of do it on an institutional scale. And quite frankly, there's a couple of Spartans that are RVers that enjoy like RVing and like RV parks. And we're probably not going to do the man camps of West Texas. We'll probably do more experiential parks. But it's definitely something that we enjoy doing, and relatively simple infrastructure as well.
Yeah. No, I love it. I'm not an RVer to date, but my wife and I have made a promise to each other that once the kids get a little bit older, we're thinking 3 years, that we're going to at least start by taking an entire summer, 3 or 4 months, and RVing across the country to all the, you know, national parks and all that kind of stuff. And then making the determination at that point in time, if we can label ourselves an RVer or if we sell the damn thing and never look at it again. But very much looking forward to it.
Yeah, I'm a little bit further behind in those discussions to convince my better half to get into the RV, but I'm working on it.
Yeah, I'm not worried about. She's all on board about getting that RV. It just depends what kind of RV it is. So like, she's not going to take me going out and spending like $40,000 on like an Uncle Eddie type RV. It's going to have to be like a Prevost or something like that. You know, with the 24 karat gold freaking finishes. And no, I'm joking. She's not that high maintenance. But anyway, hopefully Joanna's not listening to this right now.
But Lindsay, she agrees with you.
Yeah. No, it's all. So I'm in any event, I'm looking forward to that point in time. And, you know, the cool thing about RVs is that, and I don't know the exact statistics, but I know that they have experienced record annual sales have seen record highs, at least for the last year, if not last 2 years. In fact, I was reading something a few months back. Again, I can't even, give you guys a reference point of where I read this, but that there was more RVs on the road between travel trailers and RVs, right? So one and the same, than there are available spots throughout the U.S. So don't know how accurate it is, but if that's the truth, then the supply demand is out of equilibrium, which means someone needs to build some more RV locations.
We've heard the same thing, which is piqued our interest.
Yeah. Well, good stuff. Well, I'd love to move in, Scott, if we could, before we wrap it up here into the lightning round. This is where I'm going to ask you 6 questions and looking for 6 short, concise answers. And the first one is your biggest fear. What is it?
So I guess my biggest fear is that we get a deal wrong. At Spartan, we're starting to grow. We got about 30 employees now across our headquarters and our properties. And, as the CEO, there's a lot that weighs on me. So I think my biggest fear is, making a bad decision inside of Spartan that causes kind of harm across the board, and really try to mitigate that with surrounding myself with good people that can keep me from driving us off a cliff.
Good deal. How about one biggest regret?
I think my one biggest regret is not leaving my W-2 soon enough to really, when we were starting building Spartan, I probably kept my W-2 about a year too long. And I think it was just kind of a little bit of the fear monster got there. Because once I pulled that ripcord and was able to focus completely on Spartan, we really, saw some really explosive growth. So I would say that, there's probably a balancing act there for those folks that are starting with a W-2 as to when is the right time to pull the ripcord. And I think it's hard to identify that right time.
Got it. How about most influential business book?
Principles by Dalio. Like that's been a fantastic read.
Yeah, that's a great one. How about outside the daily work grind? What do you do to decompress?
Throw myself down mountains on a bike. So I'm a big time mountain biker. We got to get you out here. We just did a day at Winter Park last week and it was awesome.
Yeah, no, I'm looking forward to that, man. As you know, I'm a big road cyclist, which is very different than mountain biking, but we just don't have any mountains in Florida or else I would be a mountain biker. How about the one thing that you can't live without?
Chips and queso.
Oh, wow. I didn't know that, man. Good deal. Good deal.
I love chips and queso. Like I'm a pretty low carb diet, and just for the record, chips have no carbs in them. So
how about, if one day you woke up and decided just you no longer wanted to do what you're doing there at Spartan Investment Group, you just didn't want to be in real estate, where would you divert all your time, energy, and focus to?
Probably, I think charity, like teaching finance to kids. I grew up in a family that couldn't balance a checkbook.
Me too.
Didn't really have a checkbook for that matter. So I think teaching finance to kids early on and kind of helping them understand that if you don't control money, money will control you, and that it can be used as a tool to get what you want. And it's not something to be feared.
Yeah, no, that's great. I love it, man. And man, I really appreciate you coming on here. You shared a lot of great information. We covered a lot of different, topics and just lots of golden nuggets through and through. And what I'd love to ask of you, buddy, is if you could, what one final golden nugget of advice or wisdom could you leave with our listeners here today that might inspire and motivate them as they progress in their own real estate investing career?
I think really kind of taking some time up front, call it 90 days, and really exposing yourself to as much or as many different concepts within real estate as you can to really kind of understand what makes sense for you from an investing perspective or whatever business you want to do inside of real estate before you get started. There's a lot of folks that are like ready, fire, aim. Most of the folks saying that have actually never been in a situation where they're shooting a gun, like when it matters. I do not agree with that. But then, I also, you got to balance analysis paralysis with that. So, taking 90 days to learn as much as you can and then getting started, I think will really help you maybe mitigate some missteps that you might take.
Yeah, no, I think that's great advice. I mean, I anyone that's new getting into the business, if they're ever looking for advice, one of the many pieces I always give is you gotta pick an asset class, pick a focus, right? Like you should go experience them all, or at least touch and feel each and every one of them, and find out whichever one you feel best aligns with you today. It doesn't have to be forever, right? I mean, there surely could be a point in time where you pivot down the road. However, you got to be able to concentrate your focus in the one area, because you surely can't be the best self-storage developer, the best mobile home park operator, the best medical office developer, all at the same time. Now, it doesn't mean that you can't add those other elements down the road once you've mastered one, but trying to do that all out of the gate is quite challenging, especially if you're new to the business. In fact, it's one of the reasons I actually started this show. 6 years ago, there weren't any commercial real estate investing podcast. And so I started it for that reason, because I knew that if I wanted to, experience that type of information and content via podcast, there's probably tens of thousands of others that wanted to as well. But even more importantly than that, I didn't want to hone in on just one type of commercial real estate investing, right? There's many different ways to get into commercial real estate, right? And I wanted to expose everyone to the many different ways that, just as we're talking about today, you guys are in the RV parks. I know you're developing a mobile home park, which we didn't touch on, but your core competency being self-storage facilities. We're in the mobile home park space. However, we're also starting to expand into the parking lot sector. And so there's many different ways that you can make money as a commercial real estate investor. And that's pretty much what the last 300 plus episodes that we've done has been attributed to is, what are the different ways and who's out there doing it and being successful at it. And hopefully those that are listening, they've at least got a little bit of guidance to take the next step, or at least they can touch and feel a little bit and see if that might be an asset class that could be a good fit for them. And so in any event, Scott, for those that are, maybe interested in learning more about you and your team and what you guys have going on, where's the best place to reach you?
Probably our website, www.spartan-investors.com, or you can email me at scott@spartan-investors.com.
All righty. Good deal, buddy. Well, man, thanks again, brother, for you coming on. And it's always a pleasure having you here. And so that's all we have, my friend.
Outstanding. Thank you, Kevin.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buck, wishing you huge success. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.